Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Today's video is once another in a continuing series of videos where I'm covering the 11 GIC sectors as reported by Standard & Poor's. The idea here is I'm looking for value in each of these sectors, but I do want to make it clear, as I've tried to point out in all the other videos I've done, that I'm just looking, this is a high-level screen, and there's going to be a lot more work required once the research candidates kind of show up. But nevertheless, today's video is going to be on industrials, and I'm going to be screening for the industrials. So let's go into the FastGraphs Fundamentals Analyzer software tool, and let's go through the process of how I screened for industrials sector stocks that are attractively valued. As usual, I start with the FastGraph dashboard here. And the dashboard shows me what stocks I've looked at recently. It gives me any preset screens if I want to use the preset screens, which I encourage you to do. If I have a portfolio, it gives me a portfolio report. And then like I've done in all the other videos in these series, I've started out by looking at the Standard & Poor's 500 ETF, SPY. And I want to point out, I'm going to tackle this a little differently. By the simple powers of observation, if I look at this going back to 2004, the black line is the price of the S&P, the blue line is the normal market value, and the orange line is what I call the true intrinsic value based on formulas that are widely accepted to value companies, in this case an ETF. And what you can see clearly is, historically, the S&P trades between those two corridors very closely. Now, the numbers will change if I change time frames. These lines will change. Currently, it's an 18.9 PE on the blue line, and it's a 15 PE on the fair value line. That line will tend to stay the same, but if I drop this to like 12 years, the 18.92 that was typical over that period is now kind of going up to 20. So the point I'm trying to make is I'm simply saying somewhere between 15 and 20-ish times earnings is what it would be a reasonable valuation for the S&P based on historical norms. As you can see, the price got above that in 2021 and corrected, and it's now above that again. So my point is, I believe the S&P itself is overvalued, but it is forecast to grow pretty strongly, as you can see by these orange line accelerating here. Now, the other ETF that I have on here is the Russell 3000, and it's very similar to the S&P 500. And it has the same, I'm going to call it 15 to 20. Now, it says 19.8. That's 20, okay? This is a range. These lines, again, they're going to change if I change the time frame. Here, the normal PE is 20.6. So I want people to realize that these are ranges when you're drawing these graphs. But anyway, all I'm trying to point out so far is that the S&P 500 and the Russell 3000 are currently trading at valuations that are extremely high by historical norms. Okay, so I'm looking to find value in those overvalued markets. So I'm going to go into my screener here, and I'm going to click My Screens, and I've already screened for industrials that I think are attractively priced. Okay, so I'm going to use the industrials for total return screen that I drew here. Now I'm going to go over this screen very briefly. Okay, there are 6 things that I've screened for in the general. These are very simple screens. Obviously, the GIC sector, the GICS sector, is industrials. I want to do primary stock. I wanted to see a dividend yield if they had it. I didn't screen any number there. I just want to see a dividend if the company pays a dividend. I want PE ratios that are below 15, so that's kind of a valuation screen, which ties into the earnings yield above 6. These screens fight each other a little bit, but 6.67% earnings yield is a 15 PE if you do the math. Okay, so those are the things that I looked for in the general. Now in the historic, if I click on historic here, I wanted 5-year positive historical compound annual growth rate of earnings. I just want to see positive earnings. I don't want companies that have a lot of junk. And on the estimated, I had 2 screens. I wanted to see the total return greater than 5%. It's kind of a low bar here, but I wanted to see a total return expectation of at least 5% and earnings growth that was positive going forward. So I didn't put a big number on here because that would cut out a lot of stocks. I just wanted to see positive. So again, I'm trying to get a strong value. Then I just did the regions I did was simply US and Canada. So that's my screen. Now, when I run the query using those data points, I end up with 43 stocks that screened out using those screens that I just mentioned. So now I can get some good information here. This gives me all the things I screened for up here. But to really evaluate what the screens did, I want to create a portfolio. So we have very conveniently an add to portfolio feature here. So I'm going to click that. I'm going to name this Industrials, and I'm just going to put a number on it. I'm going to call it Industrials 3, okay? And then I'm going to say create and add to the portfolio tab. Now, the tickers have been added to a portfolio successfully. So now I'm going to go to the portfolio. All right, I'm in my portfolios here, and I usually like to refresh this screen so that the website catches up to everything. Okay, so I've got the screen here. I've got the 43 stocks that I screened for, and all I have at this point is the company, the currency, which is US or Canada, and then the price of the stock. So I'm going to create a view, and I'm going to custom create my own view here. Okay, so I'm going to look for credit ratings. I think that's something important. I'm going to look for the sector, which I already know it's the industrial, so I'm going to skip that, but I'm going to do sub-industry. So what stocks in the sector? What are the sub-industries within the overall sector? All right, I'm not going to worry too much about price, but I am going to look at long-term debt to capital because I do want to see what kind of balance sheet the company might have, a cursory glance at this point. I'm not really concerned with price return at this point, but I do want to see what the dividend yield was, and I do want to see what the earnings yield was, and I do want to see what the PE is. Okay, so I'm just going to basically create this screen, and now I'm going to call it Industrials 3 because that's the name of my screen, and then I'm just going to create the view. Okay, so now I have all these items that I created in the portfolio, and I'm going to scroll down here to the bottom. So I've got the company name, of course, is going to be in there. I've got the credit ratings, the sub-industry within the industrial, so I get a little more clarity, the debt to capital, the dividend yield, the earnings yield, and the PE. Now I'm going to bring the PE over here so I can see it more clearly. I'm going to bring the earnings yield over here so I can see it more clearly. All right, so I've got them here. I'm really looking for everything above 6%. So these are the 43 stocks that I have, and I can see that they all trade at valuations that are within my screen. Their PE ratios below 15, and the earnings yields, I can put them in order of lowest to highest, highest to lowest. The earnings yields here are all above my 6%. Okay, so my screen at this point has worked. But what I'm going to do now at this point is I'm going to go through each of these companies. I'm going to put the tickers in alphabetical order. And there's no substitute for looking at the exact individual chart of the company. I'm going to make that very clear. So I'm going to go through here. I'm going to start with the first one on the list, and I'm going to look at it, and I'm going to decide whether or not it's something I'd be interested in. All right, and so I'm going to look at the stock. I'm going to look at the business's history. I'm going to look at the valuation of it, what the operating results have been. I'm using operating earnings here. Now, I get this question all the time. I also have GAAP earnings. I can also look at GAAP earnings when I look at these companies, and there's not a big difference here with GAAP. I can also look at various cash flow modules, okay? But for sake of brevity for this screen, I'm going to stick with adjusted operating earnings because it gives me the best, I think, valuation reference. Now, I'm going to go through each of these companies, and I can just hit this arrow up here and go through each of the companies that are currently in this portfolio that I just built and review them, and I can determine if there are companies in this list that might have met my screen but I don't like. This would be a good example of one here. I don't like the dividend cut. I don't like the cyclicality. Even though it met my screen, I'm probably not interested. And Air Lease would be one that had a big problem here. I need to figure out what that was if I wanted to keep this in here. So what I do with this screen, I go ahead and I call out CULL, the companies I don't like. And again, for brevity's sake, I've already done that here. And so what I've created was 2 additional portfolios. Okay, I've created one that I call Industrials in the US, of which I picked 15 companies. And then I have 3 in Canada, which I called Industrials Canada. And these are the stocks out of the big list here, out of the 43 stocks These are the ones that I've decided personally, and you could make your own decisions on that, and they could be different than mine, that I personally want to look at. So let's go through these companies, and I'll kind of describe why I like these over some of the other choices that I could have had other for the 43 stocks. Well, Allison Transmission is a reasonably well-known business. It's had good operating results, as you can see, and the price has pretty much tracked that, although there are periods where it got undervalued. Now, I want to make a point here. This is a dynamic analytical tool. It's not designed to dictate things to you. It's designed to help you analyze a stock. So I'm going to shorten. Right now, it's the last 4 years and then the 2 estimate years that basically are looking attractive. So I'm going to drop this to a 6-year graph. Okay, and this is the more recent look at Allison. Now, there's 2 things that immediately strike me when I look at this. Number one is the company's earnings growth has been very strong at over 27%. Okay, the other thing that strikes me is the market has only valued this at about a 10 multiple. Normally, it's currently trading at a 14.2 multiple, but historically, this blue line is a 10 multiple, and yet it's actually trading at lower multiples than that. It was a little overvalued at the beginning with a PE of 1604, and it's now at a PE of 14.20. So I'm going to say that the growth of this company, not the total return, is going to be below the 27.19% because I'm getting some PE ratio contraction here. Okay, so if I can do it this way, I can click on this red dot and just immediately calculate performance, and I can look at that here, and I can see that the performance was congruent with that, about 28%, because I had good growth. Okay, if I go into the full performance calculator here, I can see that I've had capital appreciation superior to the market, and I've also had dividend income superior to the market. Okay, so this company has been a good performer. But the point I want to make is here, that's because we've had this enormous growth here. Okay, but yet now when I'm looking to decide should I buy it today, I'm going to go into my forecasting calculator, and estimates are for it to continue to grow at almost 16% a year. Now I want to make a point. I'm spending a lot of time on this first one. That's significantly lower than what its historical number has been. But watch what can happen here. If I take this 1 year off, this is 58% growth in 2021 that dropped into 34% growth, okay, and then dropped into 11% and 12% growth. So if I simply taken 1 year off of that graph, I'm now down to a 21.85 growth rate. When I'm measuring different time frames, I'm measuring different data, guys. And that's why using the ability to go through these time frames like this, I can see the growth rate has been continuing to drop as I shorten the time frame here. All right, so that becomes an important piece of information for me. When I go into forecasting, analysts still expect about 16% growth. But again, I want to emphasize that that is less than the growth that we've seen for the last 6 years, which has been 27%. And that's also a little bit more consistent with the growth we've seen historically. Okay, so again, that's all information that I'm gathering to help me make a decision whether I want to buy Allison or not. But even though I learned from the past, I'm always investing in the future. So if this company were trading at a PE ratio equal to its growth rate, or a PE ratio of 15.84, if you look at the orange box up there in the very top, the third line, the second line after the date, okay, that's what that PE ratio is. It's 15.84. If it traded at that and it earned what they're expecting for the next couple of years, this could generate almost a 23% annualized rate of return. But if the market continues to value it at a very low multiple, like 8 or 9, this is the 5-year normal multiple. Now, this is a drop-down box. I can look at this and see how the market has historically valued the stock. Now, there have been times where it did value it at a 15 or higher multiple. There are times when it even valued it at a 16 multiple. But there are also times here more recently, the last from 8 years down, the multiple has been lower, but even the 3-year multiple has only been 10. Okay, so I'll go to the 3-year multiple just to be a little more aggressive. The 5-year seems to be a little bit over. I think it's worth way more than 8 times earnings. This would actually mean a loss to me. So what am I doing here? I'm assessing the risk of investing in the stock at this level. Now, I could take the assumption that the stock should trade at the 15 multiple, If I look at it historically again, there were times when it did trade above that multiple, and there were a lot of times when it traded below. And more recently, it's been trading below a 15 multiple, as you can see by the orange in the pop-ups here. And it's now moved up to where it's gotten close to that 15 multiple. It's at 14.20, just below the orange line, which in the long-term graph is a 15 multiple. So I got a decision to make. Am I willing to say the market's going to continue to value it at this more realistic PE, or is it going to continue to value it at this undervalued low PE? Those would be the things that I would need to make in my decision. So I spent a lot of time on Allison here and kind of gone through the process of looking at it. So I'm going to be a little bit more succinct with the rest of them, but let's go through the other 15 in the portfolio here. The next one I want to look at is American Woodwork. Now, the first thing I noticed, no dividend. I see that went through a period here of losing money for 4 or 5 years coming out of the recession. So I'm going to shorten the time frame just to give me some better. Over going back to 2013, it's been about 15% growth. But I'm always looking down here at this column to see what the numbers are. I'm going to take a couple of more years off there. I think it's going to give me a better and more realistic look. And so this has been about a 17% grower over that period of time, but I still got some pretty big numbers in here. So I'm going to take a couple of more years off. And what I find is since 2017, and by the way, this has an April fiscal year, I want you to notice, stock's only been growing about 10% a year. So let's just jump to forecasting. Analysts think it's going to continue to grow at 13%. The normal multiple in this stock has been about 11, but that would still give me an attractive rate of return. Okay, and if it traded more in line with its fair value or intrinsic value, it'd give me almost a 29% rate of return. But there's no dividend here. The company doesn't have a lot of debt. It has no credit rating. That's simply because it probably didn't file for one. And it is cyclical. These are all pieces of information I'm simply gathering just by instantly getting that information, looking at the chart. It's not about just the numbers that some people always want to scoff at. It's about understanding the business and understanding how the market values that business, okay, and where the prices are trading in line with what the business should theoretically be worth. The next one here is Brinks Company, Security and Alarm Services. You can see a very high correlation between price and value, the value being the orange or the blue line. It's been about a 17% grower long term. More recently, it's even been a 19% grower. Looking at forecasting on the stock, it's expected to grow at 22%. So this is kind of intriguing. The normal multiple that the market applies has been close to 16. That would give me a tremendous rate of return if it continued at that, I'll call this conservative level. If it traded at its growth rate of 22%, I could make a real lot of money. Now, the company pays a very small dividend, and as you can see by the white line here, the payout ratio is around just barely over double digits. 10 to 15% is all they're paying out of their earnings. All right, and if I go back to the historical chart, you can see that the payout ratio has been low. This area below the white line is the portion of all the earnings, which is the dark green shaded area, that the company's paid out. And that's the same information that's on the top of the graph here in the light green shaded area, just to indicate it does pay a dividend. Now, it's grown the dividend sporadically over time. It only pays 1%, so this isn't about the dividend. It's really about the growth, but yet it's pretty attractive. Now, it's not investment grade, and it does have a lot of debt. That would be something else I take into consideration, but it does portend to offer a great return. Now, CSG Systems here is about a 7% grower. It's got a nice dividend yield of 2.3%. It pays out somewhere around 30%, 25 to 30% of its earnings in dividends. If I max the chart, it's giving me 11%. But here's, again, I want to make sure people use the tool correctly. I've got these crazy numbers here in the beginning, so I'm going to get rid of those numbers. Those numbers are aberrant. Okay, this is a 5 or 6% grower. Looking at the forecasting graph, forecast to be more of the same, 5 to 6% growth going forward. So a 15 multiple, this would still give me an attractive rate of return because it looks so undervalued at a 12 PE. But it is only double B plus, it's not investment grade, and it does have quite a bit of debt. The normal multiple on this stock has been about 15, 14.85. So the market has treated it pretty well. It's a data processing and outsourcing services. And I can just, again, view how the stock price is traded within those valuation references. And a lot of times the market puts a premium valuation on this stock. It might be attractive, therefore, at this dark blue line here. But again, I'd want to do a little more due diligence and dig deeper because it theoretically is trading at a very attractive valuation right now. But I'd have a lot to learn with this company. Now, one way to do that is go into external links right on out of Fast Graphs and go into what the business does and what industries they support and so on. So you can learn a lot about the company just by going into their financials. The next company on my list is going to be Enersys. And Enersys is an interesting company with good growth. But again, I used a dynamic nature. Growth more recently has been less, but very recently, it's actually been higher. Okay, I can see that just by looking at the graph. Okay, I can see that we had a flat period of earnings growth here, but then I can see this acceleration. Forecasting-wise, analysts are expecting about 8% growth over the next couple of years. The normal multiple has been about 14 or 15 again. So as long as this is below the orange or blue line, I would say this looks like it would be an attractive investment. It has very moderate debt at 39%, but again, it's only BB+. It is an industrial, and all industrials, or most industrials, will have a level of cyclicality that you have to deal with as an investor. Genpact is one I'm very interested in. I see no reason why analysts are not forecasting a dividend cut here. I think that's probably a data error, all right, because the company just started paying a dividend in 2017. So it doesn't have a great history, but it did raise the dividend every year. And when I'm looking at dividend, I'm going to look at operating cash flow. The dividend is extremely well covered by operating cash flow, and the dividend is extremely well covered by free cash flow. So I don't see any reason why the analysts would be expecting this company to cut the dividend, but that's something I would research further. But again, I like the growth of this stock. I do see aberrant growth back here at 08, so I'm going to get rid of that. All right, and now I've got almost 10% growth going forward. Forecasting is for about 7% growth going forward. The normal multiple would be about 18 because, again, if I look at this stock historically, the market tends to put a premium valuation quite often on this stock. So this could be a very interesting time to buy Genpact, which is the data processing and outsourced services company. The next stock I want to look at, this Quantum Billion, they had some special dividend or something they paid back there. So I need to get rid of some of this data to try to get an idea of what this company looks like. And again, by using the orange bars up here that give me times of different years, I can learn a lot about the company. Going forward, it looks attractive with a 10% forecast growth rate. The market normally values it around a 14 or 15 times earnings. What this forecasting calculators are, they're saying, if all this happened like the analysts are expecting, what can I expect to make? So I'm not just investing in a stock or contemplating investing in a stock on a hope and a prayer. I actually have very specific, by utilizing the Fast Graph research tool, it helps me run my numbers out to their logical conclusion. I'm going to go on to the next stock here, which is Owens Cornings, which is a building products company. Again, there's a cyclical nature. Coming out of COVID, we went through this huge growth spurt here. If I look at these last 6 years, growth has gotten very strong. From a forecasting point of view, analysts expect growth to kind of revert back to more normal levels. The normal multiple on this stock has been about 11, which would mean it's slightly overvalued. But yet, if I really study the long-term history of this stock, most of the time it did trade at a 15 PE. It's during this recent spurt that it traded at a normal multiple. So Owens Cornings would be one that I would have loved to have bought maybe a couple of years ago. I'm not so sure I'd be wanting to buy it now, but again, that would require more research. It is investment grade, and it does have less than 50% debt. I like that. The next stock on here that I'm looking at is Oshkosh Corp, which is construction machinery and heavy transportation equipment. Very, very cyclical company. I'd be afraid to invest in a stock like this, or I'd be reticent to invest in it. Analysts are looking at 6% growth. Analyst scorecard, which I didn't show for the other companies, is spotty in my view. In other words, it's hard for analysts to forecast a company that's this cyclical. But it does look attractive from the point of view of the value. It's only trading at an 8, and even with a 6% growth rate of 15 PE would not be out of the question. And that's what the normal multiple has been. on Oshkosh. So that's taking a look at them. Paccar Inc., which is construction machinery and heavy equipment also, again, a cyclical looking stock. It went through this huge growth spurt again coming out of COVID. Estimates are expecting growth to resume to more normal levels, but this would still give me a very attractive rate of return at a 15 multiple, and at a 12 multiple, which has been normal for the last 5 years, it'd be less. But again, don't just depend on those numbers. Evaluate different time frames so you get a feeling of what you're doing. For example, in forecasting, when I'm looking at the normal multiple, the tool, fast graphs, always reverts to the 5-year normal. But I can look at what all the normal PE ratios have been. And you can see I've got 16, 17, 14 multiples on this stock historically. It's only been recently when we've had this high growth rate that we've seen these lower multiples, which is kind of contra to what common sense might say. But the stock price did react to the surge in growth. Back here, when it was really growing, you could have averaged over 39% a year. Again, use the tool to help you make what I would call rational decisions based on the facts as they're presented. Here's Ryder Systems, the cargo and ground transportation, trucking, etc. They went through a pretty bad time during COVID. They recovered very strongly. The stock has recovered subsequent to that, and we've seen this trajectory. It is expected to grow at double-digit rates. The normal multiple on this stock for the last several years has only been about 8. But once again, if I evaluate that, that's only been more common. It's always been a 12 to 15. So I can even use a 12 multiple here as a conservative number and come up with a pretty interesting opportunity to make money. So that's saying if it grew these earnings, which are the same as you'd see on the estimates tab, but the market only put a 12.67 multiple, I'd make almost 12% a year. Now, I could do that all these different ways. If I put a little higher multiple, like 13.68, then my rate of return could be 15, almost 16%. My point is, this is an analytical tool that you utilize to help you make more informed decisions by studying what the kind of company it is, what its history has been, and so on. I prefer companies like Genpact, or here's Science Applications International, a pretty consistent grower, especially since coming out of COVID. Forecasting, it's expected to grow at around 8% a year. That would give me a double-digit return with growth, PE ratio expansion, and the dividend yield. The normal multiple on this stock has been 15, so the market seems to like it. It is double B plus with 53% debt, so I'm not crazy about that, but I'd want to learn more about this company. It's been a pretty consistent grower over time. The next one here would be Timken. Timken is quasi-cyclical, I like to call it, or cyclical, for those of you who are more skeptical. But the stock does look undervalued today. Forecasting-wise, we're expecting 11.5% growth going forward. That would indicate a 15 multiple would be fair value. But the normal multiple the market has been applying has only been about 12.5, but that would still make it a 10% annualized rate of return. And again, I can use this drop down. I can be a little more aggressive and put 12.89. All of a sudden, my return would jump up to almost 11%. So these are what-if scenarios. I could say at a 14 multiple, my rate of return would be closer to 17% a year. And of course, at a 15 multiple, the normal 15 multiple, my return would be almost 20%. So you can use this tool to come up with rational expectations of what the stock might deliver if it delivers what the analysts are expecting. And again, I'll do it on this one as well. You want to go to the analyst scorecard. One thing about industrials, they will have analyst scorecards that are a little sketchy, and you should be taking that into consideration when you're evaluating these stocks. The next one here is Textron. Now, Textron came out of the Great Recession with some really poor operating results, and you can see the stock collapsed. They eliminated their dividend, or all but eliminated it. They do maintain a very small dividend. You can see it, but barely. Okay, but if I shorten this to, say, 15 years, the company since 2012 has produced really good results. It did have an earnings big drop in during COVID, but it still was profitable, I might add. And the stock did react during COVID. We did have this drop, but then we've had this immediate recovery. Looking at the stock going forward, 15% growth. Looking at the normal multiple, the average has been about 17. This really offers a real strong opportunity. It's BBB rated with 32% debt. Doesn't pay much of a dividend. If you're looking for growth or a total return, this stock may be one that's intriguing now. It's not crazy undervalued, it's fairly valued. But because of the growth factor, it does offer some pretty decent rates of return. The next stock here is WNS Holdings. I'll go to the max again. It's another one that I like this because it's had consistent growth. You see this period of time, and this is something else people get all hung up. There's a lot of stocks, Microsoft, Apple, that have been trading at these very high valuations. And here we saw WNS, which is the data processing and outsourced services, trading at what I'd call high multiples starting in 2017 or maybe even 2016. And they held those high multiples, except for a short stint where the COVID crash came, but it was a flash crash, as it's often called. Then the multiple stayed high. Now all of a sudden we get a drop in earnings here and the stock is trading at more normal or more rational levels, I should say. And looking at a 15 multiple with a 10% growth rate, this would give you a 25% a year. Looking at a normal multiple on the stock, which has been 20. But again, here's where you get in trouble with fast graphs. This is mathematically correct, okay, but that's over the last 5 years. If I evaluate those last 5 years, all right, that's all these years of these high multiples. If I go back to that forecasting now and go back to that normal multiple where I get the drop down, if I look at, let's say, the last 2 years, the last 1 year, that's dropped down to a 17. So if I put that on here, it would be attractive. In this case, I would be more comfortable looking at this as a 15 times earnings company, which still makes it extremely attractive looking. Okay, there you have it. What you've got here is the 15 stocks in the U.S. industrials that I think are very attractive. And I'll just finish up here by looking at I'll go into my portfolios again, go when they were created. And I've got the Industrials Canada, which I only have 3 companies in this group, so it could be quick. This would be that ADEN that we looked at. Not sure exactly what this company does. I know it's a trading company and distributor. Again, I could go directly into the company's website and learn more about it. I can also do a lot of other research on what Adentra does. I can just learn a lot of information about the company here, which I'm not interested in, but this is one that does look from a standpoint of forecasting, is expected to grow over 10% a year going out for the next couple of years. I'm looking at the normal multiple. The market puts a 9 multiple. That would still make it a double-digit return company if it was able to achieve the earnings growth that the market is expecting. The analyst scorecard has been better than a lot of industrials, but again, they missed estimates about 20% of the time on the 1 year forward with a 10% margin for error and 25%. So you want to take that into consideration as well when you're looking at the stock. But anyway, that's Adentra. The next one on the Canadian list would be COI, Calian Group Ltd. I'm sorry, I said COI, it's CGY. That was a slip of the tongue. Pretty consistent grower. They did pay a special dividend once, it looks like. The stock looks very inexpensive right now. It's diversified support service, expected to get double-digit growth. When you see it blankly, it just means there's no analyst. We're down to one analyst here, so I probably wouldn't look any further than past here. This has a September fiscal year is one reason why we're not getting a full 2 years of data here. But going out here, this stock looks like it's poised to make a lot of money, even looking at the normal multiple of 15. It's got a 41% growth rate. So it's only got 27% debt to capital. I kind of like that very much. It goes through periods of growth and short periods where growth stalls. But again, an interesting company to look at. Then last but not least, in the industrial sector would be Finnings International. Pretty quasi-cyclical here. It goes through periods of cyclicality. Looks like it got a very good dividend record. They've either held it or grown it every year since they've been doing it. The stock looks very undervalued today. I expect to be about an 8% growth rate. Once again, I would stop short. I could go out here, but there's no dividend forecast, but I could still see what the PE and the growth would be, so it's still useful. I'm looking at the normal multiple of, say, 13. This still looks like it offers a very superior long-term rate of return. It's BBB+, which is quality investment grade, just one notch below A. And it's only got 30 to 31% debt to capital. So I like Finnings International a lot at today's valuation. But anyway, that's it for my video on industrials here. It's Chuck Carnevale. If you like this video, give me a like, ring the bell so you get announcements of future videos. I've still got more sectors to cover in this series. Might be a little spotty coming up. I've probably got one or two more before Christmas. Then it might be a little lull in doing the videos. Even a dedicated value investor like myself needs a little time off here and then. But anyway, I want to wish everybody a Merry Christmas and a happy and prosperous New Year coming up. If I don't talk to you again, but I probably will. But thanks for watching, and share this video or these series of videos with your friends. Take a look at Fast Graphs. What a great tool to help investors make more informed investment decisions about the stocks that they're considering investing in or already have invested in. It's got great portfolio management features, a great screening tool, which, by the way, is going to be getting better and better. The guys are working on really adapting that screening tool to more common language, like show me all stocks that are below the orange line, that kind of stuff. I don't know whether we'll pull it off or not, but we're working on it. Anyway, thanks for watching, and we'll talk to you again real soon.